Welcome back, you legends. I'm Dr. Cal. Let's get right into this crazy video. Stock market insanity just keeps on coming. Stock market today closed up 3% on the Nasdaq, 2.75 on the S&P 500, and 2.43% on the Dow. On the stock market map, we can clearly see a sea of green. Everything is glowing bright green, with only a few exceptions. Healthcare and consumer defensive, as well as utilities, were the laggards for the day. IBM was the only red stock in the tech sector due to their miss on the earnings today. Everything else was up massively. We have semiconductors, we have Nvidia up 5.5%, AMD up 5.5%, Apple 2.5%, Google 4+, Amazon 3.9%, Facebook 5%. So these are big numbers. The laggards were again utilities, defensive, and healthcare. The most defensive sectors of the stock market were the laggards today. Everything else was 2.5% plus in the green in what was a full-on bull attack, risk-on move today, squeezing all of those shorts from yesterday. Now, this crazy insane market action is very typical of a bear market rally. In fact, this reminds me so much of the 2008 crash, where we had massive rallies and massive crashes. Take a look.
Apple's up more than 6% right now. Google about 3%, but Dell, Intel, Research Motion, and Microsoft are all to the upside. Look how strong.
Trading did not disappoint. 400 points higher. Yes, indeed. The market's roar higher last 30 minutes of trading as volatility once again rules the day.
Most of the techs this morning, if not all of them, down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Really, you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure.
And we're not getting the bid wanted. We're not getting the stop trading, and we see where the buyers are. We're just, every day, they're pounding it.
We're down 9% today. The Xetra DAX over in Frankfurt is down by 9%. The Paris market down by 9%. Austria, which was briefly suspended earlier on in the day, is down by nearly 11%.
This market is as volatile as you'll ever see.
Traders saying this is the craziest day they have ever seen in these markets. Veteran traders saying they've never seen anything like it.
eBay is down 6.5%, and really you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure. Yahoo down 8.5%, Cisco 6.5%, Research in Motion 10%.
This could be the most serious recession in decades. And that means life, as most Americans know it, is about to change, in some cases dramatically.
So guys, does that remind you of anything? I mean, it's insane, right? Now let's get back to our chart. The S&P 500 today slammed into this resistance line. We had several significant reactions to this trend line. Right here we sold off, right there, and right here. Today was the only day where we managed to close above this trend line in what really was a very strong move to the upside. I mean, we moved $10 on the S&P 500 and we're still moving up in the post market. We're getting much closer to filling this gap right here at the $401 level. And we're also getting mighty close to the July 27th deadline, where we have that Fed meeting coming in. The market is pricing in between a 75 and a 100 basis point rate hike. Now, we only really have 5 trading sessions left before we hit that Fed meeting. We could simply move sideways and chop for the next 5 days until we get that Fed meeting, at which we might see a last squeeze to fill this gap and then a reversal. Another possibility is that we simply run and hit that level before the Fed meeting and then we sell off on the Fed meeting. The third possibility is that we simply sell right now, right off this resistance line. So we go back down and then we might see another attempt to rally and fill that gap. I'm leaning more towards a period of chop and perhaps hitting that $400 level right before or right on the 27th of July. Now, we still have to cover a lot of distance. This is $10 we're talking about. The Nasdaq, on the other hand, has basically already filled this gap right here. We've already filled the gap in the post market. So we really need the industrials, the energy sector to start picking up the slack to fill this gap, because tech has already done it basically. And we don't have much time left, because if you remember, guys, on July the 28th, just a day after the Fed meeting, the Bureau of Economic Analysis will drop that GDP number for Q2, which the Atlanta Fed is already forecasting to be a negative number. And if we get a negative number in Q2, that would officially put us in a recession. And now combine the fact that we are running into resistance and a Fed meeting and the possibility of an announcement of a recession, this could get really ugly really quickly. So in terms of risk reward to the upside, there's a lot of risk for a $10 move to the upside, while on the other hand, to the downside, the reward is $27. So risk to reward on the downside is significantly larger than the upside at these levels. Going back to the Nasdaq, we were watching this blue line, this resistance line right here in the descending channel, where we had significant reactions several times now. We've broken through that resistance, so we could still see more upside in the tech sector and the Nasdaq. We have now retaken the 50-period daily moving average. The last time we did that was right here back towards the beginning of April, late March, where we had that massive rally and then an even bigger sell-off. And in the last couple of videos, I did talk a lot about the fact that the current moment is very similar to this moment back here, which was the beginning of the earnings season for Q1. We are now in the beginning of the earnings season for Q2, where we had a sizable rally and then we hit resistance and we saw a lot of selling. We're now seeing the same thing really. We've been chopping upwards and we are getting much closer to the upper edge of this descending channel. So again, risk to reward is significantly skewed to the downside, but much more so on the S&P 500 than the Nasdaq. Now let's take a look at the DXY, the Dixie, the dollar index. We've seen this significant sell-off in the dollar after the European Central Bank announced the first ever rate hike in more than a decade. Does this mean that we have put in a top on the dollar? Personally, I do not think so. I think we get at least another leg to the upside, perhaps form a negative divergence on the MACD, and then maybe we could start talking about the dollar possibly topping. But right now, I do not believe so. This sell-off has fueled the rally that we've seen in the stock market so far. But again, we are running into a lot of economic events, a lot of earnings. We have the Fed, we have the GDP figure coming out. So a lot of things driving volatility in the stock market. Now let's jump into the VIX. Again, the VIX is still showing a red flag. Today we put in a higher high on the S&P 500, but then again the VIX, the fear index, did not manage to break the previous low. Remember guys, July 15th, last Friday, was when the VIX put in that sell signal, which marked every top in the stock market to date. Right? If we take a look at the S&P 500 chart right here, we can clearly see that the signal did mark tops every single time in the stock market, and then we sold off systematically. This is really the only time we've seen the stock market rally after putting in this signal. There was only one time prior when this happened, and it was right here back in November of last year, where we put in a lower low on the VIX, breaking the previous low, which would have marked a similar signal to what we're seeing today. I did not include this in my previous video because I did not really consider this a double bottom with a lower low, because this low was so close to this low, right? Whereas in all the other examples, the second low was significantly lower than the first low. And again, it was the only time where we saw the signal flash, and then we had the market rally for a few more days before beginning to sell off. So this is still a possibility. We could see the market again attempt to fill the gap on the S&P 500 and then sell off, right? And it's moments like this where you have to be very disciplined as a trader, building up your position as you see strength, as long as you have a strong conviction in your position. Otherwise, you will just end up paper handing your positions and getting slapped around by the volatility. So this signal is still in play. The market action today does not make this signal void. In fact, again, we've been seeing the VIX put in a higher low even though the market has been putting in a higher high. So when the market puts in a higher high, you would expect that the VIX would put in a lower low, not a higher low. This is definitely a red flag because it means put options are getting more expensive even though the market is moving up. A lot of hedge funds and money managers are still actually very bearish and buying puts even though the market is getting stronger. And again, that's pretty typical of a bear market rally, a convictionless rally. As the stock market moves up, volatility remains high in bear market rallies, and this is no different. Let's jump into Apple. Again, Apple slammed into this resistance box. This is a critical zone. We had several reactions in the past acting as support, then broken through. Once broken through, it acted as resistance to date. We're getting really close to the upper edge of this descending channel. Apple has earnings coming out next week on the 27th of July. So right after that Fed meeting, we will have earnings come out of Apple. Now next week, if we see Apple sitting at this level right here towards the upper edge of this descending channel and inside of this resistance zone, that would honestly be the perfect entry point for a short position right after Apple reports. You get that implied volatility out of the option chain. Puts get much cheaper, and suddenly the stock collapses and those puts make a lot of money. So that would be a golden opportunity handed to you on a golden platter by the stock market. I do have a short position on Apple that I opened right here that I will be adding to if we see any additional strength from Apple. Taking a look at the 10-year yield, the 10-year yield is actually showing some signs of life again. We're getting really close to a bullish crossover on the MACD. We have this double bottom right here. We need to clear the 3.12 level right here for yield bulls and bond bears to come back into the market. That remains to be seen. We have this massive negative divergence with a higher high on the daily chart and a lower low on the MACD. Usually this does signal a top, so this could simply be a dead cat bounce. We sell off again right here and continue to go down. Whether yields continue to move up or go down will depend entirely on inflation. If inflation continues to be hot and if things like commodities and oil pick back up, putting more pressure on inflation and pushing inflation back up, this could lead to further upside movements in the 10-year yield, and that will crush PE ratios on the stock market. Jumping into energy, I did not erase the notes from the last video. I talked about this positive divergence where we had three lows on the daily chart, putting in a lower low on the price action and then putting in a higher low on the MACD right here. And that divergence did signal a move to the upside. And in fact, energy stocks did end up seeing a really nice rally to the upside, as you would expect from this technical structure. Where we could go from here, we could possibly see another test of the $77 level on the XLE, right as the stock market continues to rally and attempt to fill that gap on the S&P 500, we could definitely see XLE continue to push to the upside, especially as energy companies continue to put in really strong earnings. Oil is looking okay, right? We formed somewhat of a base right here with a double bottom formation, and we're now moving to the upside. We're hitting resistance. This is a significant resistance level, right? Because we had reactions in the past acting as support, and it's been acting ever since as resistance. So this is a very critical pivotal zone. We are beginning to see a bullish crossover on the MACD. So if we see a break to the upside, a test again, where it does not go back below this zone, that would make for a nice entry position to the upside, right? But it has to break through and then hold for a while. Now let's talk about Tesla. Again, Tesla has been forming this bearish pennant, this massive bear flag. It's been coiling for a long time now. We have earnings coming in tomorrow after the market close. And if we continue to see strength in the stock market, we could see Tesla attempt to fill this gap right here at the $860 level. But again, guys, remember, unfortunately, because Tesla has been trading at an extremely high PE ratio, even though as the company has been beating on earnings, we've seen Tesla selling off after every earnings so far in the year, right? It sold off after that Q4 earnings report, even though it was really strong. Again, it sold off after the Q1 earnings report, even though it was very strong. So this will be highly unpredictable. and in my opinion will depend on sentiment in the broader market. If the market continues to show strength running into the Fed meeting next week, we could see again Tesla attempt to make this rally and then sell off from this level here. And the downside target on Tesla, the full measured move would probably take us down, as we've talked about in the past, to the $400 level. But that would be going out into at least September, October. Let's jump into the SMH, the Semiconductor Index. Again, I've drawn up this resistance channel, and every single time we've hit this channel, we've seen the semiconductors sell off. We had extreme weakness in the Semiconductor Index in the second half of June. Now it looks like we have formed a reverse head and shoulders formation, and we're moving to the upside. We're getting really close to the resistance channel. In my opinion, this would be the spot to exit and perhaps a potential area to start looking at buying puts. GameStop still looking really strong. We have that split coming up at the end of the week. Again, I expect GameStop to continue to show some strength going into the split and then start to see some weakness after that split is out of the way. AMC again still showing strength. I'm still looking at this 200 daily moving average for a touch, and that would be where I would exit if I'm in this trade, which I'm not. Now let's talk about earnings coming up. We had Netflix, Johnson & Johnson, and Halliburton report today. Johnson & Johnson beat on both revenues and earnings per share. Halliburton had really strong guidance, both really as expected. Netflix was a wild card, and the market liked the fact that the subscriber count actually declined by 1 million instead of 2, right? The company was forecasting a 2 million loss in subscribers, and now the company is guiding subscriber growth to hit 1 million by Q3. So Netflix is really interesting at these levels. We might have seen the base in Netflix. We might have seen the bottom. I would not rush into things. I still think the market will see weakness going into September, October. We have Tesla, ASML, United Airlines coming in tomorrow. I expect ASML to do really well based off TSMC's earnings last week, and that will probably fuel the last leg in the semiconductors, the last leg in the semiconductor rally. I expect to see United miss at least on profit margins due to the global energy shortages and high jet fuel costs. Tesla is a wild card, could go either way. We had those China lockdowns that hit Tesla's sales and manufacturing in China for at least 2 weeks out of the quarter. So that will no doubt put a dent in the earnings. And the question running into those earnings would be whether those China lockdowns have already been priced into the stock. If so, Tesla could see some nice upside, barring there are no more surprises, especially after the Twitter fiasco. On the economic side of things, we had the building permits come in today at 1.69 million, a slight beat of the forecast. Housing starts did miss, and we're now seeing consecutive declines in housing starts. So the housing market is definitely cooling down, which is to be expected after mortgage rates more than doubled. Tomorrow we have home sales. Thursday we have the job numbers. And on Friday we have the manufacturing PMI for the S&P 500. Nothing really major this week in terms of economic figures. It'll be more about the earnings. Next week is going to be all about the Fed funds rate, that FOMC meeting on Wednesday, and that GDP figure on Thursday. And this will probably be the figure that ends up making the stock market poop its pants. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.